can start up with our next panel sessions. Okay. We invite on the stage the speakers of our next panel, which is Focus on Private Equity panel. Mukesh Mehta, Senior Managing Director, Blackstone. Vineet Mehta, Managing Director, Motilal Oswal Alternatives. Vijay Chakravarti, Managing Director, Afama Capital. Manish Mehta, MD and Co-CIO, Samara Capital. Nitin Nair, Co-Founder and Managing Partner, Filter Capital. Ratna Mehta, CEO and Managing Partner, Fundalogical Ventures. Anand Kharad, Vice President, Technology Holdings, Healthcare and Life Sciences. Vandana Pai, Partner and Head, Investment Funds, Bharucha and Partners. To set the stage for the panel, we'll have a short presentation on what the data says on the state of private equity. To present the data, I welcome on to the podium Arun Natarajan, founder of Venture Intelligence.
So this is a quick overview of what we at Venture Intelligence do. So events is just a small part of what we do. At core, we are a data company, and we have a video also running through the day on what our new V2.0 of our databases are. Essentially on private company financials and transactions, including M&A, private equity, venture, PE in real estate. So if you would like a one-to-one demo, please step up to the registration desk and register for a one-to-one. We can do that at 4 p.m. onwards. So that's quickly about what we do. Just to set the stage for this panel, just updating where we are in this so-called funding winter. From a data perspective, obviously we are nowhere near the peaks of 2021, right? And forget about 2021, we are far cry away from 2022, right? What about 2023? So we think, and the data suggests, this is the quarterly numbers, the recovery is well underway from an investments perspective. We will get to exits a bit later. You can clearly see the third continuous quarter in uptick, and in the current quarter too, we are seeing a continuity on this trend from an investments perspective. The spring back is more on the volume side of things. The big ticket deals have clearly dried up, nowhere near the 22 levels, forget 21. So that is, but there is clear sign for optimism, and this is not just one quarter, it's 3 continuous quarters. And like I said, if we project from 22, 23 to, the current quarter trends, we are looking up definitely, from a volume perspective or the number of private equity transactions that are going through. This is venture included. In the value side, it will probably match 2023 is what obviously a lot of questions, open questions that the panelists will know far about, in terms of crystal ball gazing, what happened yesterday and whether that matters. It's for the panel to talk about, but this is what the, into 4 numbers say from a projections perspective, right? So, the big one, unicorns are back too. We just saw them, 2 of them. So if you look at the 2021, we had to accommodate 44 unicorns in, just 1 year. That's a data presentation challenge for us, and things have kind of, dropped off dramatically in 22, and we pretty much, 23 and 24, just 2 unicorns. And good that, these are rare sightings, but they are happening, right? So the quarterly picture of the same unicorns. This is the area where, again, from a data perspective, difficult to find out where venture ends and where private equity takes off. So we had these SoftBanks and Tiger Globals minting unicorns. So where, they are now, we don't know. But, there it is. We are kind of, again, going up on that unicorn slide as well, right? So, That's even more sensitive. Who's no longer a unicorn, whether the markdown is 99% in one particular case, but there it is. So these are some of the larger transactions, that have kind of gone through in the first quarter, and, more have gone through in subsequent days. But there is a common pattern, if you see those, that it's dominated no longer by tech, unicorns included, but more from infrastructure, financial services. These are getting the big dollars, right? So the panel, Blackstone included, thanks Mukesh for joining this panel, but is kind of, in that the traditional industries. This slide will show you that split by industry. So it is largely reversion to the 2018 pre-time frame where, tech and tech related, industries were kind of getting a third of the pie. That has clearly fallen. The big brown one, is IT and ITES. You can see a continuous fall, and including the share of the pie in the first quarter this year. And healthcare and energy have stepped up. And in terms of obviously financial services is the traditional number 2, number 3. The big pink one is actually telecom. A couple of the deals in the previous slide, ATC, iBus. These were big telecom transactions. That's the big pink one. Why we've left it there? Because in 2020, 2021, telecom represented by just Geo was a big part of the pie as well, right? So now, it's kind of back, but even without Geo. So a lot of infrastructure industries are very clearly, front and center from a private equity industry perspective. So that's, again, something that the panel will expand on. Buyouts. Look at the big orange one, So buyouts are here very, very, very strongly, including this year, and their share has only been growing. So that's again something that the panel can talk about. Is this a one-off? Is this something that is going to last more? Quickly, as I promised, on the exits front, things have been up and down. And as we know, in terms of the share of the pie, it's really been the public markets that have been the champion in terms of exits. And even more so this year until yesterday. Who knows beyond, but there it is. Strategic sales, secondaries, these come and go, but what has clearly been an uptick of secondary transactions between private equity funds has been growing as well, and clearly more sustainable based on where the IPO markets are. Right, so some of the exits, like I said, the last 4 ones are public market sales that have dominated. One strategic sale right at the top. This is just to give a comparison of just the IPOs that have happened this the first half, and this is the kind of IPOs that kind of took place last year. Mamaearth ended the year, and that was a venture exit going all the way to IPO. Not very, very often do we see something like that, but here it is. So clearly the IPOs have been driving, and whether that will get sustained is something that the panel will also dive into. So without taking up much more time, I will leave it to the panel. And we'll have a quick introduction of Vandana, and then the rest of the panel can go for a self-introduction after that. Thank you so much. Take care.
Thank you. Thank you, Arun. I take pleasure in introducing the moderator of the panel, Vandana Pai, partner Bharucha and Partners. Vandana Pai is partner and head investment funds practice at Bharucha and Partners. She advises clients on complex private equity investments, including on structuring and negotiating investments and exits across diverse sectors, such as infrastructure, hospitality, real estate, and technology. Vandana advises domestic and international funds, portfolio investors, angel investors, family offices, foundations, and financial investors on all matters related to investment cycle, from formation, downstream investment, follow-on transactions, restructuring of holdings, and exits. Over to Vandana and the panel.
Thank you.
Yeah.
Hello. Thank you. I'd like to start by thanking Venture Intelligence for organizing this conclave and inviting me to moderate this panel. We have a very interesting discussion lined up where, like was just mentioned, we will talk about the expectations that the esteemed panel has for this year, the trends in fundraising, what they are seeing out of exits. But I think to just start, if I can just request each of the panel members to introduce themselves and their firm. Manish, if you could start with you.
Yeah, thanks, Vandana. So, I'm Manish Mehta. We represent representing a fund called Samara Capital. We are a mid-market buyout fund. We've been around since 2007 and manage close to $2 billion now. We invest anywhere between $50 to $150 million, and as I mentioned, control deals primarily.
Good afternoon, everyone. My name is Ratna Mehta, and I represent Fundalogical Ventures. Fundalogical is an early growth private equity fund. So we basically play a little bit between the cusp of the VC and the PE. And also, what we do is we focus on taking significant minority, but with areas like supply chain, consumption, and peripheral sectors. So we, whatever consumption is related to supply chain and driving that, I think we play the entire chain, but with an underlying theme of sustainability, because supply chain anyways lends itself directly to sustainability. Prior to this, I spent over a decade with Everstone, and a few years earlier was with JP Morgan Chase. So very pleased to be at this panel. Thank you, Vandana. Thanks, Venture Intelligence, for having us. Look forward to this discussion.
Thank you. Firstly, thank you for Venture Intelligence to invite me for this conclave, and thanks to all the audience who's going to be part of this. I'm Vijay Chakravarti, a partner at Affirma Capital. We're a mid-market focused private equity fund. We have about $3.8 billion of AUM. We originally used to be part of Standard Chartered Bank. We're one of the oldest mid-market focused emerging platform in the country. We've been operating since 2002. In 2019, we spun out of the bank and created Affirma Capital. And the spin out was led by the senior management of Standard Chartered Private Equity. We're currently focused on investing check sizes of roughly between $30 and $60 million in mid-market companies. We're usually focused on profitable enterprises. And we work with these companies to scale them from either a regional player or a local player to a national or a regional champion. Typically, we take significant minority stakes and usually are quite active in our portfolio management. I personally have been with the firm for 12 plus years and in private equity in India for 16 plus years. Pleasure to meet all of you and look forward to this panel discussion.
Hi, I'm Mukesh Mehta. I'm a senior managing director and partner with Blackstone India. Spent 20 years in Indian private equity. Blackstone is one of the largest funds in India with close to $50 billion of assets under management. Just to give you a perspective, that number will be the top 10 business house in India. And glad to say that it's one of the largest geography for Blackstone globally outside US and one of the best performing geographies. We primarily focus on buyout in 5 sectors. Just keep it on. We primarily focus on buyouts in 5 sectors with the minimum equity check size of. Hello. Hello. Yeah, we primarily focus on buyouts, partnering management teams and founders, and I've done more than 25 buyouts in this country, and pleased to be here and discuss our insights with you guys.
Hi, before I start my introduction, I think on a lighter note, we don't invest in technology because technology fails. But yeah, hi, this is Vineet. I'm an MD with Motilal Oswal Alternates. We are a growth equity focused fund. We've been present since 2007 and today we manage about $2 billion, principally across 2 strategies, growth equity and real estate. One of the things that is very core to us is backing entrepreneurs and entrepreneurship in India. And that's why from a focus perspective, we've always looked at helping build entrepreneurs, helping them scale businesses, making businesses which are India focused and India for the world. And that's how we look at a lot of these businesses and opportunities. Excited to be here and excited to be part of this panel. Thank you.
My name is Nitin Nair. I'm a co-founder and managing partner at Filter Capital. We are a tech-focused private equity fund launched by myself and my partner who have experience at firms such as Warburg Pincus, Multiples, and Temasek. We typically lead and co-lead Series B and Series C rounds of companies in IT services, enterprise software, and technology-led businesses in traditional industries, whether it's in logistics or consumer products, retail or financial services. We recently closed our first fund. We raised 800 crores. We have a portfolio of 4 companies in software, mobility, and logistics, and are investing out of our first fund and looking for smart entrepreneurs to meet and other investors to co-invest alongside.
Hi everyone, my name is Anand Kharan. I am part of Technology Holding and TH Healthcare Life Sciences. I'm part of the healthcare division. I lead the APAC practice for healthcare and life sciences. We are an investment bank, 25 years in the making. We focus on 2 sectors, technology and healthcare. It's a London headquartered global boutique. I've done 12 years of investment banking across multiple local boutique banks in healthcare life sciences. Happy to be part of this panel and be associated with Venture Intelligence for this event. Thank you.
Hello. Venture Intelligence just wanted me to say that the last 30 minutes of this session will be kept for Q&A. So please do keep your questions ready, and we'll be more than happy to answer them. And we look forward to an interactive discussion. To start, Mukesh, if I can address the first question to you, how do you see the private equity landscape having evolved over the last 2 decades? It'd be great to get your insights on that.
You're a echo, I guess. So, I think Nitin will also concur with me. 2 decades back when I joined private equity, I think we can hear some echo, yeah. 2 decades back when I joined private equity, I remember my first deal was HDFC, where to put in $650 million to take a 5% stake, we had to pay a premium. And those were the days where, the sense which was given to private equity firms is if you are able to get 5% on 10% of a listed company, you have to pay a 10 or 15% premium. That's how we started in private equity, and fast forward, I think that time almost 95% of the deals were minority deals, mostly PIPE deals, private investment in public enterprise. And when I see 20 years down the line, 2024, world has changed completely. If you talk today, more than 150 to $200 million deal size, 80% of the deals are controlled deals. So gone are the days where you do, and I doubt anyone does a PIPE deal anymore. So it's primarily a majority buyout-led market. So in terms of industry as well, we have matured as an industry. What started as just providers of capital, just buyers of asset and not builders of assets, has changed completely. It's no longer a market where you buy low and sell high. It's a business where you have to build businesses, you have to add value. Bulk of your returns are not driven by multiple expansion, but what growth you drive in the business. So I've seen the market evolved a lot, and also it's not just the market, it's the maturity of founders as well. 20 years back, 2 decades back, most of the founders wanted to stick around with the business, wanted to control the business, and wanted PE firms to be just passive minority shareholders. And the world has changed completely. Today, founders realize what private equity bring to table, what sort of talent they can acquire, what sort of companies they can acquire, what trajectory the company can go into. And they have also understood that being a minority shareholder and professionalize the institution by getting great CEOs is a much better approach to build value versus controlling it themselves. They matured, and that's how we can see a lot more buyout transactions. And especially success of Indian PE is also determined by exits. The exits, in fact, the Indian private equity has grown almost close to 13x in the last 15, 20 years. And same has been the case with exits, which has grown 5x. And in any business, actually in our business especially, it's not about investments, it's exits. and successful exits are driving money into India.
Yeah, no, so I think just to add to what Mukesh said, one other thing that has evolved and that's very important for a mid-market fund like us is the ecosystem, entire ecosystem of doing controlled deals. So previously, good talent, it was hard to attract them to join a promoter-run company, right? They were in established multinationals doing well, looking for the next promotion, probably a posting outside India into the headquarters. Now, what has really changed is people have seen success when they join erstwhile, say, promoter-run companies or companies that are not part of multinationals, so to speak. And they have transformed it, created value for the business and for themselves. So that entire ecosystem that is needed to build the control and buyout deal system has come a long way. And I think that's a second thing beyond promoters looking to diversify their wealth and monetize the assets, which has also driven a lot of the buyout system evolve over a period of time. What has also happened is, the large part of deals, if you look at developed markets, come from carve-outs, take private, for instance. Carve-outs have started to happen from what we are seeing. As large conglomerates have grown much bigger, there are businesses that are not focused for them. So we have started looking at those kind of those opportunities. Take private obviously is something that still very early stages. If it does come, and many things dependent on that, it's dependent on many things to happen. That's obviously a very, very interesting play as well. We'll wait and see when and if it happens.
Since now if you can talk about the future, what are your expectations? What are Firma's expectations for the year to come or the years to come?
Yeah, I just want to add to what Mukesh and Manish said. See, before I talk about the future, the other interesting thing that's happened to the market is 20 years ago, if we had all been in private equity, all of us would have been competing for literally the same deal. Blackstone, Sequoia Capital, and Firma Capital would have bid literally for the same deal. Today, the market is very clearly segmented between venture, growth equity, and mid-market, and late stage there too, and then the large buyout type of players like the Blackstones of the world. And this actually creates a very interesting dynamic in the sense that for people like us who play in the mid-cap space, we can exit either through an IPO after we've grown the company through the cycle. But if for whatever reason the IPO market is shut, then we have the likes of Blackstone looking at companies that are, in some ways the governance has been tested and tried. A private equity fund or a venture capital fund has done the diligence of the company, and the basic check marks are already checked for them to look at it and then take it to the next level. So this did not exist 20 years ago. So the market is much more mature than what it used to be. With respect to future, look, we are very optimistic despite whatever happened in the election results or whatever yesterday, which was different from what the market expectations were. Our pipeline, I think, has not been as strong in a very, very long time. And I think part of this also comes from the fact that we are somewhat micro in the way we focus on opportunities that we evaluate. And we look at a space that is, for whatever reason, not really looking at IPO as an alternative. These are companies with a few hundred crores of revenues. They've been profitable for a few years, but they're not yet ready for a potential listing. And therefore are looking for value-added private equity players with respect to coming in and giving them the capital to grow to the next stage. So our outlook is reasonably optimistic and our pipeline is very, very strong.
Thank you. Vineet, any thoughts for?
Actually, in sync with what Vijay said, private equity as a sector has evolved quite a bit. While we continue to be, as Motilal Oswal, continue to focus on entrepreneurs or founder-driven companies, I think there is a very clear market segmentation that's happened, and the breadth of businesses that are getting funding today, plus the number of new entrepreneurs that are coming to the market, I think that has added to the potential deal pipeline and the opportunity. what that does is that creates a virtuous cycle across deals. So even though we speak about funding went on the VC side, a lot of the VC funded companies have become very interesting opportunities for the growth equity today. Valuations have corrected. Business models are interesting. They are strong. They still need capital. So from that perspective, I think the opportunity set or the market set has become much wider. It's a lot deeper. What Manish also mentioned is actually kind of true. Today, finding talent and getting talent to come either in a promoter-driven company or a P-backed company, both have become positive. There was a point in time where people had concerns about whether this P investor will stay, exit, and what's my future. I think some of those questions today don't exist, and there is a clear journey which professionals have in promoter-driven P-backed companies as well, and eventually going to public markets, capital markets, etc., as well as wealth creation for such folks. I think a lot of this has kind of evolved. So today, if you, just to take an example, if you look at Chola, it's one of the oldest groups. But they themselves have created in financial services a number of folks who've come out of Chola and set up their own businesses, be it Equitas, be it Veritas, etc. So I think that opportunity has been created, and I think that's just growing. And there's a play for every strategy right now.
Understood. Anand, if I can move to you, I think last year was an exceptional year for healthcare, right? Just focusing on that, what are your thoughts for the coming years?
We believe that obviously healthcare, life sciences is a very, very important sector in the country, right? We are still underpenetrated with respect to whether it's hospitals or whether it's availability of medicines at a large scale to, let's say, rural population. I think that's something that will play out in the next 2-3 years. I mean, businesses have seen a lot of ups and down cycles where some of the businesses which went up during COVID, at least valuation wise, have corrected, but these businesses are much bigger now, right? So for example, your online pharmacy deliveries were very, very small 5-6 years back, but that has changed now, and they are bigger businesses working towards profitability and everything. These businesses will require more money, so there will be a mix of growth capital and M&A in the sector. Growth capital where again these fast growing companies in whether it's health tech or telemedicine or mental health, these are the upcoming sectors that we also as a bank are focusing on, because we feel that these are the sectors that probably will drive the next 3-5 years of growth in India. Plus your traditional sectors like hospitals, pharma, they are seeing more of consolidation. We've seen a lot of M&A happening in the last 2-3 years. That will continue to happen. Bigger hospitals have realized that, let's say, there's a big emergence of single specialty hospital that has happened in India, which was always the case in US and Europe in developing economies, where, let's say, a dialysis or a cardiac or let's say an onco was probably leased out to someone else to do, and there are big dialysis chains out there in the world that does only dialysis. That has played out because as a BU in a larger hospital like an Apollo or a Fortis or anyone, they might not be profitable units because the per square feet revenue does not match up to, let's say, their ARPOB expectations in general. So these businesses have picked up, like really, really strongly in the last 5 years. We've seen very, very large deal happening in single specialty, which I don't think people imagined 5 years back that was the case. But some of these sectors I think will do fabulously well in the next 3-4 years. IVF has seen so much growth. I mean, people would think as a country of 1.4 billion people, is IVF fertility a problem for us? It is a big problem in urban population. The fertility is actually below 2, which means that the population is actually decreasing. And we've seen multiple transactions happen in the IVF sector as well in the last 2-3 years. Again, these are the sectors which will have a lot of consolidation. These smaller companies which took 20, 30, 40 million dollars are probably looking at a stage where they want to merge with bigger chains and probably see the next level of growth, because from being a regional player to a pan-India player, it's a very, very different game, but that will happen. Multi-speciality hospitals obviously has seen a lot of M&A in the last 5 years. It will continue to be the flavor of the month, but I feel tier 2 towns, the Bharat economy, which I believe will need more focus going ahead given what has happened yesterday. I think those regions, tier 2, tier 3 towns where there is still enough dearth of, let's say, good hospitals in the country, that will take off like we've not seen before, right? This will be another COVID moment for those tier 2, tier 3 towns where you will see a lot of expansion by larger players, regional players, and obviously private equity plays a very, very important role because everything cannot be funded by debt and everything, and you need private equity, and that's where we feel a lot of action will happen in the next 2-3 years.
Just talking about sectors, I know for Fundalogic, sunrise sectors is a key focus. Can you just talk about like how you see that and how you see that evolving?
Hello? Yeah. So I think one of the things to add on in terms of how the whole segment has evolved is also a little bit of focus, right? And that focus emerges from the depth. Like 10 years, 15 years back, when we used to try invest in consumer as a sector, on the minority side at least, you wouldn't find many deals, correct? Because they were all cash-rich companies, the capital was not required. And therefore, the whole trend about buyouts, as you know, the funds started moving from minority to doing buyouts, which was a natural transition, which Mukesh all spoke about. But if you see India as, you know, an economy, today consumption is driving the economy across sectors. We've reached 2,500 per capita GDP in USD terms, and that is when things start changing. The J curve, which US saw in the 70s and 60s and China saw in the early 80s and 90s. With that, what happens is that when you want to push your economy through consumerism, and with a focus on manufacturing, which the government is trying to push, saying make India the global supply chain, I think one of the lifelines which is emerging as a sector of importance then becomes supply chain and logistics. And therefore, we truly think that the India growth story is intact, there are opportunities across various sectors, but this sector is now starting to see a lot of investments. So while through the Gati program and various other national logistics policies, the government is trying to build a lot of infrastructure, there is a support ecosystem required around it, right? The enablers of that, the connecting dots, if I may say. And I think we see that which is driven by technology, which is driven by innovation. That is where we see in supply chain logistics a huge potential for investing, right? Plus, I think because we combine that sunrise sector with consumption, which has been played out for now 2-3 decades in India from an investing perspective, they're fairly interconnected. And when we say supply chain, I think the whole landscape of the value chain begins from saying innovation in sourcing to innovation in inventory management to saying warehousing. We are fairly bullish on warehousing right now as a sector. We've seen a lot of funds come and build the brick and mortar warehouses. But when we are driving the India manufacturing story and the consumption story through warehousing, there are a lot of services required around it, whether it's automation, whether it's tech which is required to manage that, whether there are players who are enabling the aggregation or players who are just managing the entire asset-light supply chain. I think everything, kind of plays into that cycle of saying that the India growth story needs to be intact, then you need a lifeline or a backbone to kind of support it. And I think that's what we're trying to pick. But the difference is that 10 years back, if somebody said we would invest in supply chain, people would really wonder, are there enough opportunities? But as the market matures, and like fintech or like healthcare has gone through its cycle, we're saying that there are immense opportunities across new sectors, right? Energy transition is also very, very related to this, because right now, most of the corporates are talking about making their whole supply chain green, right? Whether that is the circular economy, waste management, or whether that is the entire EV ecosystem. So I think it builds into some of these newer sectors.
No, I completely agree with that. Nitin, I know your fund is also now tech focused, so it'd be great to just get your thoughts on, what do you see? Are there subsectors within this that you see growing? What would be your focus?
I'd actually like to highlight Vineet's point earlier about finally we're seeing the emergence of interesting businesses within tech. But even though we're tech investors, we actually don't invest in black box technologies or try to take technology risk. We like to see business models emerge. And if you look at there's been so much excitement around the tech sector over the last 20 years, and look at how much venture dollars have flown in, look how many new companies have been created. You know, I think that though a lot of that capital has been driven towards the expectation of good business models being built in tech and the enamoring of how large market opportunities can create businesses of scale, but there was less attention paid to the underlying business models or the moats or the competitive advantages. And often too many players got funded in speculative industries, too much competition, and frankly, we've seen a lot of capital destruction. And you see a lot of early stage venture investors, of course, from the US or from China enter India, and then a lot of late stage capital, whether it's SoftBank or hedge funds coming in because they've made so much money in China. And they viewed India to be the last great bastion of big technological disruption and big technological outcomes. And I think that like any industry, it kind of goes through a hype cycle, and we're kind of seeing the fag end of that hype cycle now. I think even if interest rates come down, I don't actually expect that behavior to return because people now know it's kind of hard to build businesses that are profitable when there's so much competition and unit economics are poor. But I think private equity has noticeably been careful in that sector. And we've taken our bets when businesses reach profitability, when there's something more defensible about the businesses. But now I think there's going to be a lot of interesting activity because I think that the environment has made entrepreneurs very careful about how they think about capital efficiency, how they think about the choice of financial partners. I mean, you've seen enough instances now where entrepreneurs were kind of driven to build something big or go home, and the VCs kind of leave if the business doesn't work out, but the entrepreneur's left holding the bag. And so there's a lot of that institutional learning happening within the entrepreneurial community to say, okay, we want to build right. And I think with that, then this audience will start getting very, very interested in the emergence of those business models. And we also then, as a result of that, focus on industries where there's enough proof points that yes, it can be done. So we end up spending a lot more time on technology services, IT services. We look at enterprise software. We may stay away from entire industries where we think the outcome is unknown. Like, I don't know whether I can take a view on the agri-tech industry as a whole, much less companies within that industry. But I know that traditional industries have created winners. Like in logistics, you have a Safe Express. You now have a delivery, so you can start taking bets on other logistics companies because it's kind of proven out. Similar in omni-channel retail or direct-to-consumer brands, there are enough examples. So now private equity investors can say, okay, there's something that can be done here. And then from a stage perspective, we say, okay, well, we try to, target companies when they've already gone through that Series A and now it's clear that is this going to be another high growth, capital guzzling, venture-backed business? It's not for us, it's for the hedge funds and then SoftBank. But if it starts to feel a little bit growthy, maybe the VC guys will say, well, we're not going to make 20 times our money in the base case, so we're not sure we can do this deal. That's where guys like us can get involved. And then we can be the bridge capital between Series A and late stage private equity or the public markets, because the risk return and the downside protection works for us, even if the upside is not enough to get venture investors excited. That's fine. Let them choose the next drone company or the next defense tech, deep tech, EV, whatever the case may be. We'll focus on entrepreneurs building good businesses.
If I can ask a follow-on question, right? You mentioned that you've just closed your first fund. Has the way you actually approach deals and the sectors you're looking at, did your LPs, are the LPs now influencing that more? What has just been your experience? Do you think that they're actually now kind of coming in with restrictions and with requirements that then are impacting deal activity?
It's a really good question. I will say that our LP base, and of course, we're fortunate that they've backed us, but in a way, whenever you raise your first fund, they're being patient with you. I will say that we have H&I investors and family office investors, and we have institutional investors. The H&I and family office investors actually like early stage. If you're going to invest in it, many of our businesses are actually not profitable. The unit economics are good, but they're not yet profitable. But if they're not profitable, a family office investor may say, if I'm going to take a risk on profitability, I might as well go as early as I can in the cap tables so I can get as much outcome as I possibly can hope for, because I don't care about mortality risk because I am a family office. There's room for mortality risk in my portfolio. With institutional investors, they're looking for predictability and returns. And so they want to see, they like it when the businesses are larger. They like it when the businesses are closer to profitability, and we talk to them whether they do co-invest alongside us. So we are seeing investors try to pull us in different directions, right? The family offices would like to see us do a little bit more VC stuff because they're taking a bet on a first-time fund. They'll live with the mortality risk. The institutions want us to see more profitable businesses. And I think that as an investment firm, and I think Fundological, you guys would see the same thing, we're creating a new category which is sort of at the cusp of VC and PE. And in a way, your investors are patient with you with your first one, but you're going to have to deliver performance in order for them to be really convinced that the investment strategy has legs. But it's great to be here at least.
I'd actually love to add to this what Nitin said. I mean, he was very right in saying that it's a little bit of a new category, right? 15 years back, early growth was being done by private equity funds, a $10 million deal, right? Most of them have moved on to doing larger deals. So now when you're playing in that bucket, which is at the cusp, the trick is that, how do you invest in businesses where you're able to show sustainable growth and exits either to a larger buyout fund, or strategic. Strategic is a huge avenue for exits for us as well. But what happens from the LP perspective is that a lot of HNIs and family offices, because they have seen in the last 5 years the unicorns or the startups move from 0 to 100 in 1 year, 2 year, I think that patience really is required. So he's very right in that sense. Also, one of the other trends that we are seeing is co-investing. So most of these guys are very keen to start investing on their own directly. Some are doing, some are sitting on the fence, learning with the funds and then co-investing. So I think that is another huge trend which we are seeing from the larger guys saying that, we are very happy to back a differentiated strategy in a different category, but we would love to see how we can, take a pie of some of the deals that you guys are doing.
Sorry, Manish, do you see that being different with global LPs? What has been your experience?
With regards to sector choices, are you saying? Yeah. So, I mean, our view is, our LPs have given us money to find the right investment and the right sector. So they have left the call to us. And the fact that we are sector agnostic really doesn't force us to look at a particular sector. See, our view on looking at sector, or, as they say, the fact that everybody knows it's a great sector or a great investment is the biggest oxymoron, right? Like if everybody knows that prices will be driven up, right? So our view on looking at trends and sectors is look at what are the ancillary industries that benefit from it. Like say if the entire VC system or direct to consumer system has been growing in India, we realize that manpower supply is an industry that's an indirect beneficiary to it. So we made an investment in that. Manufacturing is a growth sector. People are saying that manufacturing will grow in India. But we don't know which sector, which subsector in manufacturing will succeed, which business will succeed. But we know that there'll be more insurance that will be sold. So we bought into an insurance broking business. Similarly, accessories, gems and jewelry is growing at a fairly rapid pace. So we bought into a logistics business that supplies to that. So that's the way we look at a particular sector-based thinking rather than going deep into what's the next trend like or what's going to be the next big sector.
Understood. If I can just move to exits, because I think that's also very large on people's minds. Mukesh, if you've had a very successful track record of taking your companies to IPO, including Aadhar Housing, which happened recently. Just how do you see IPOs now? Like, do you see that as being the main exit route going forward? Just how do you see exits happening in future?
I think when it comes to exit, and when we take our deals to investment committee, also people talk, what's the form of exit? and at least my experience over the last 2 decades has been exits will come only if the performance is great. So I think more than exit, which form to exit is first make sure that if a company makes good returns, good return on capital employed, predictable returns, predictable cash flows, you will find an exit. Be it IPO, be it secondary to another buyout fund, be it a continuation fund, which is an example, or a dividend recap. So I think focus should be more on building businesses, making sure that you have a predictable cash flows. And India being a country with the amount of capital which is coming into market, $2 billion of SIP money coming every month, they are looking for good businesses. And if you have a great business, you will find an exit. That's period. Coming to your point, IPO has certainly been, if someone would have asked me a question, even 10 years back, that can you even imagine selling a controlling stake of a company in public markets? And Nitin would agree to it. People would say, are you joking? That can you sell 100% of your company in public market, a private equity fund? And that's the reality right now. Not just us, there are peers of us who have sold controlling stakes of these companies. And what we have seen is Indian market have really matured. They know PE firms are building great businesses which are here to last forever, with great professional management teams, and great businesses find buyers. And these are not PE firms who are just in here, are looking at a multiple arbitrage, going public and just stepping away. We have seen the businesses actually going even further after we have taken these companies public, after we have exited investments, be it Embassy, be it Sona Comstar, where we made 15x our money, and today the stock is 2x, we would have made 30x our money now. I think in terms of IPO has been a great source given the market the way it is, and fundamentally market has also changed. What was a FI driven market is domestic driven market, and thanks to government regulators also getting new forms of exit. We used to own we are the largest landlord in this country, and REIT used to not exist in India till Embassy REIT, which actually we worked with the regulators and got the REIT structure in India. So government has also been quite conducive in getting various forms of exit. A REIT is one more form of exit. Another form of exit has also been, which not many people in this room know, but dividend recaps. If your business is growing, in fact, we just completed last month a dividend recap where we took 70% of our capital, still owning 100% of the company, but just doing a dividend recap, because there's a good source of financing for good quality companies. So that's one more form of capital. As I said, continuation fund, which a point which never existed, NSE continuation fund. Great business, you will find a buyer. And unlike other markets where I see in US, when I meet my colleagues in US, in UK, that's primarily actually still a secondary led buyout market. India is still, we are lucky enough, we are still in a virgin territory where we do mostly primary buyout deals. As our market mature, we'll see a lot of secondary buyouts as well. And strategics are always there. So I think exits in a form have matured is not just IPO. We have done close to 9 IPOs in India. We have exited controlling stakes in Embassy, Sona, Comstar. We've just taken Aadhaar public. But I would still say that IPO is not just the only form of exit. IPO is the form of exit which you see because it's marketed a lot. There are a lot of other forms, be it dividend recaps, secondary buyouts, and strategics also. We have exited 3 companies in strategics, 2 strategics. So it's matured enough, and I think it will mature even further as the amount of investments which have happened over the last 5 years come to market in the next 5 years.
Thank you. Vijay, your thoughts?
Yeah, I actually completely agree with Mukesh on the point that, look, the priority that us investors need to be better now? Yeah, I completely agree with Mukesh. I mean, with respect to exit, I mean, the most important thing is for you to build a really high quality company with very strong fundamentals, right? There could be these market cycles when people get lucky, when companies not that fundamentally strong can get lucky and get listed. But we all know it's not going to last forever. So I think it's very important to focus on profitability, return metrics, all the usual good stuff. But look, I want to add another perspective to this exit story in India, right? Because if I was in Hong Kong for a week just a few days ago, and I remember a time when LPs who invested in India used to look at India and say, this is a market where there's always lots of promises, but exits never come, right? I think that flavor has completely changed now. And then added to that, if you look at what's happened with China, you have a whole bunch of LPs who are sitting on a reasonable amount of capital, who are looking at India literally for the first time because a huge window of opportunity that they all used to capitalize on for all practical reasons is now shut. The good thing is a lot of people are with a micro lens focusing on India right now, but a large number of them, some of them have never even visited India for the first time, right? So I think the onus is on this group to kind of educate this group of potential LPs about the market that is out here, the opportunity that is out here, and that it is actually an interesting opportunity for them. But with respect to IPO being an interesting exit opportunity, look, the market, I agree again with Mukesh that it's fundamentally changed. If you look at our portfolio today, in the last quarter, we've listed 2 companies. The most recent of which is TBO Tech, where we had come into this company at an equity value of $80 million in 2018. We listed it at 1.2 billion, and then it popped like 40-50%. And even with all the volatility that's happening today, it's still significantly up from where the listing happened. I don't think these kind of listings in your wildest dreams you would have expected 15 years ago. So I think the market has fundamentally changed. IPO still remains to be a very interesting exit window. But at the stage at which we come in, which is the mid-cap space, which is the couple hundred crore kind of company, for us, if for whatever reason, for a few years, the IPO window gets shut, then we do have alternate avenues, a lot of which Mukesh explained. So I think we are thinking we are in the sweet spot with respect to flexibility of exit options that are out there. And then India itself has, with respect to the depth of potential exit opportunities, has significantly changed.
Thank you. Vineet, for financial services, would you say the same?
So financial services has been a little interesting in the last 12 months. I think if we look at what's happened is financial services has always been a very dominant play in the Indian capital markets, typically between 35 to 40% of market capitalization. So from an investor perspective, obviously the focus has been very high. But one trend that has emerged a lot, and while it's been a positive that a lot of PE funds have been able to liquidate their positions in financial services, there's today also an overhang from a capital market perspective for a PE-backed financial services company coming to the market. And there's also a significant shift away from a classical lending-based company which comes to market to other subsegments of financial services, be it insurance broking, etc. So if you look at that weightage of financial services, which still is about 35%, 1/3 is today non-lending. So there is a shift that's happening. I think financial services vis-a-vis other sectors is a little ahead in the curve from an evolution perspective. Because capital has been a raw material, it was also one of the first sectors which raised capital, be it private equity or otherwise, or get listed. I would say markets are becoming a little cautious where there is too much supply coming in. So exits, while a lot of them are slated in the next 12 months, valuations are getting impacted as a result.
And Anant, when you advise your clients on exits, what would you?
So in India, actually exits is a very, very typical phenomenon, right? In a market where we were, let's say, a month back, right? IPOs become, the hot cake, right? Where, people want to do IPOs left, right, and center. But when there comes a bear phase, that is when, let's say, more private transactions happen and strategic buyout happen more. So for us, because we are more M&A and private equity focused, we believe both strategics and let's say larger buyout funds like Blackstone and the likes play an important role where people like Samara, where they invest in mid-market companies and all of that, and they become large. You can obviously sell it to a larger buyout fund as well. So for us, I think the focus remains to go after these strategics, these larger buyout funds in general. There is a big emergence of companies in healthcare, especially the traditional healthcare, where let's say 2 hospitals are there, 3 hospitals are there, and probably the doctor does not have a second line of people that want to run the business. There are enough private equity owned large buyouts, hospitals, chains, pharma companies out there that are looking at bolt-ons to expand into regions. We see that as a category expanding more and more now, because companies which were probably 20-30 crores in revenue probably 10 years back are probably, if they are doing well, they are at 200-300 crores, which makes them, as the panelist said, more visible to people. You can predict cash flows now. You've seen the growth phase. It's stable, and that is where we advise our clients to keep the options open and not be very attached to an IPO or let's say a buyout. It has to be significantly open in their minds that anything can happen given how the market is. And we have to also respect that every private equity has a timeline, right? That they look at in a company, whether it's 7 years, 10 years, but they have to exit eventually because they have to give the money back. It's not their money that they are running. So I think we advise our clients to keep all options open, and in a market like today, IPO becomes the topmost priority, but it's a cycle. I mean, it comes and goes. You've seen a lot of buyouts happening in the last 3-4 years when the markets were not great. We've seen so many IPOs that have happened in the last 1.5 years because the markets are good. A lot of companies that we were pitching to for buyouts have gone for IPOs, unfortunately. But that's how the market is. That's how the nature of the game is, right? So yeah, all options open for us. But as advisors, we have to be dispassionate, because when you're selling a company, you want to maximize the value out of the business as well. And somehow IPOs become that maximization point at some point of time. So everything possible for us.
I'd also like to add one more point. People think that markets are great and PE firms are, here to just make opportunistic exits. We have a huge responsibility. We are not a founder which has only one company to take public. Every company which goes public, there's an equal responsibility to make sure that investors make money, because you're not here for only one IPO. Every year, every 2 years, we'll be coming after one after the other IPO, right? So it's easy to say that private equity firms are taking opportunistic exits, making sunshine, hey, while the sun shines. That's not the case. We are long-term players over here, and this is not just the last IPO from any of the buyout funds. So it's very responsibly, for us, it's a big responsibility is that public market investors make money and see the success, so that the next IPO which comes to the market is equally successful.
No, and rarely do you see the PE fund exiting their entire stake at the IPO. I mean, we exited TBO and we still own 21% stake in the company. We actually are larger than each of the individual founders with respect to stake, right? So it's very important for us to make sure that the incoming investor makes money, which is why you see in a lot of cases we leave value on the table, right, ultimately. And then look, with respect to the financial services point that Vineet made, public market investors have now become very, very smart, right? If it's a 90% PE owned company, they look for that additional 20% buffer, because they know that a lot of these PEs are slowly but surely going to exit. And you'll see it's a great leveler, ultimately, the public markets.
And Manish, have you seen just how the IPO markets are doing? Does it impact your deal origination, because you're also into buyouts? Do you see that competing with you?
The thing is that the size of the companies we look to buy themselves are not at a stage where they can go for an IPO, right? So the fact that IPO markets are strong, it plays a role in valuation setting, but it doesn't really play in that company able to IPO itself, right? But valuation setting itself is a devil there, basically. You need to surpass that. So other than that, I don't see too much of a challenge of IPO market being buoyant playing a role in entry.
Understood. I think we'd like to end with just asking each of our panelists, like I think there have been multiple references made saying everyone thinks that PEs are only focused on returns, you know, they're being opportunistic, etc. Just, I think PE is a lot more than just the capital which is being provided. So if I can just ask each of my panelists to just talk about how their firms contribute to the portfolio companies beyond capital. So Manish, if we can start with you.
Yeah, so definitely. So as I think Mukesh mentioned in the beginning, it's not only about buying low and selling high. It's also about creating value in between, and that's a big part of what we do. So there are various ways. I can talk about Samara that we work on. So for instance, we do a lot of roll-up plays. So if you just dissect our portfolio, you'll see a lot of roll-up plays. So this is something beyond, operations value add. So this is more M&A driven. And that's our core strategy. We have done it multiple times. So that's one way. We have done global partnership, for instance, with Amazon, with Iron Mountain, Yum Brands. That's the other way. And then there is obviously the traditional ways of finding ways to increase revenue and decreasing cost, and there is a team that does that. That's part and parcel. But beyond that, we keep thinking of what are the other ways we can add to what already exists. And that's certainly core, maybe our panels can add more, but.
Sure. No, absolutely. I think when you're investing in a company for, a couple of years, like most early growth or the buyout guys do, I think one of the core things is being on top of what is happening over there, right? And helping them navigate, right? The entrepreneur is the captain of the ship. We are there on an a la carte model basis to help them. And I think that is what a decade back some of the funds started doing, having operating partners and getting them to help the companies in their journey, right? Whether it is strategic or it is more tactical, help them with the right people. Because 2 or 3 areas where we see, at least in the growth stage, where the company needs a lot of hand-holding, and the top of the order is the kind of people that they can get, right? Getting the right people is very important, and funds do a lot of work in helping build a team for them. I think second is the overall strategic direction, correct? But as Fundalogical, I think our platform is slightly differentiated because here we're a combination of people who've been investing, so investment guys who've done deals and who've worked with the companies to help them. There are also anchors who basically are industry stalwarts. So they've built businesses, they've run businesses, sold, got private equity, exited those deals. And that really helps because, as an investor sitting across the table and telling the promoter what to do, you can go to a certain level, right? And we all do that. But sitting across with a person who's actually built a business in that space, I think the value add is very different. For example, we just invested in a cold chain solutions company. They're trying to solve the problem of, cold chain, where most of the companies have got stagnated because it's a high capex, low ROC business. But this guy is doing something different in terms of aggregating the excess capacity which is there already existing in the space. And I think as a firm, what we're trying to do is 3 things, right? Helping him on the network building, which is building a footprint of that, helping him in terms of opening doors to a whole bunch of clients. And third is the people, right? The tech piece especially, because tech has become a huge leverage, and they will agree to that across businesses. I think technology can help companies move from level A to level B in a very different fashion in terms of building operational efficiency or growth.
Yeah, so I'll start firstly by saying that, we spoke about industry maturity and how the PE industry has evolved. I think with respect to entrepreneurs not anymore looking for just dumb capital and actively seeking capital that comes with a fair amount of value addition capabilities is one of the biggest changes that's happened in PE over the last 15, 20 years, right? And we as a strategy only invest in companies where the entrepreneur is open to us playing an active partner role, not just coming and taking a stake in the company. And that goes hand in hand with our strategy of only taking very significant stakes in the company, even if it's minority. Over the last 22 years we've been in this market in India, I think we've kind of refined our value addition approach, and our value addition approach is centered around three very fundamental themes. One is using our networks and our capabilities to bring in CXO level talent, as well as enhancing the quality and the texture of the board. If you look at the companies, the stage at which we invest in, which is these mid-cap companies, a lot of times family-run enterprises, they find it very hard to attract very high-quality talent. Us coming on board adds a stamp of credibility to signal to the market that this company is willing to institutionalize its management. And also being able to structure incentive packages so that the senior management that comes on board is able to create wealth for themselves. If you look at our portfolio across the last 20 years, literally in every single one of our companies, we've added at a minimum 2 CXO level talent hires, and in many cases, we've also brought in a CEO. The second area that we add value is with respect to tuck-in acquisitions. Again, the size of companies that we come in, M&A is not their core competency, and the promoter is much more focused on building his business. So our team actually rolls up their sleeves, work as the in-house corporate development team for the company in evaluating acquisitions, screening, diligencing, negotiating the deal and structuring the deal, and then consummating the acquisition, and then working with them on the post-merger integration part, post the acquisition. Again, this is a very important part of our value creation toolkit. In one of our portfolio companies, Prodapt, in the last 4 years, we've done 4 acquisitions. In TBO, in the last 4 years, again, we've done 4 acquisitions in multiple geographies, helping them diversify their revenue footprint. So that's the second aspect of our value creation. And then finally, using our pan-regional footprint, particularly in the mid-cap space, there aren't many PE funds in India with a global or a regional footprint such as ours. So we use that very, very actively to help these companies diversify their revenue sources outside of India. And that's a huge value additive driver for the companies. And truly the entrepreneurs appreciate something that we do here. So that would be our approach to value creation.
Hello. Yeah. I think I started my discussion that we are business builders and we have no doubt about it, because I don't think so we are smarter than others in the room. Every deal which comes to market, there are 10 players looking at it. And if you think that you bought it cheap, that's not true. First point. The value creation which drives in any business is what value you create. It's not just the profit growth, but what's the trajectory of the company, what company you've bought, and where you've taken it. I'll take you, rather than giving more gyan, I'll go by examples. Aadhaar company, which we took public, this company 5 years back was about to go bankrupt. It was in the business of financial services. We bought it from Vadhavan Group. For 12 months, they didn't have financing. And within 3 months of Blackstone coming in, we got 30% of financing within 3 months of acquisition as financing from all top-notch banks. We got a great CFO in place. We changed the perception of the company by getting a best-in-class corporate governance from O.P. Bhatt, who was the chairman and CEO of SBI, as the chairman of this company. And that changed the trajectory of the company. Today, it's India's largest affordable housing finance. The profit of the company has grown 8x in last 5 years. So that has been the trajectory. Coming to industrials, Sona Comstar, where we made handsome returns. When we bought this company, it was 90% of revenue came from only one customer, which is Ford. And 100% of the business was actually internal combustion engines. What we saw in US was the world was shifting to EV. We spent a lot of money on R&D side, and the fruits came in after 3 years, where 25% of the revenue of the company came from electric vehicle segment. Today, every company in the world uses a Sona Comstar part, at least a EV company in the world. Coming to IT services, we bought a company called Emphasis. It was declining 20 quarters in a row, 20 quarters of decline, quarter on quarter. Within a year after Blackstone buying it, it started growing at 16%. There was no magic which was done. But what we brought to table was the might of Blackstone portfolio companies. We got 100 million worth of business within 12 months of our acquisitions. We got a great CEO in the form of Nitin Rakesh from Cintel. We elevated the relationship at the CEO level. And the same company, once it starts growing 16%, it's ultimately it's a services business, and the energy is different. So that was, so I think, and coming to healthcare, we just bought a company called Care Hospitals. We now merged with Kim's Hospital now, which was not even the top 10 hospitals. Now it's the top 5 hospital chain only in the world. So I think the perception that people, most of the returns are made by private equity is just by buying low and selling high. That perception is wrong. It's a very, very competitive market. And certainly for us, if we don't see if there is any value added angle from our side where we can change the trajectory of the company, we don't get into the company. Most of the returns are driven by profit growth. And unlike developed markets like UK, US and Japan, in Japan, 80% of the capital is actually leverage. It's only 20% equity. It's actually reverse in India. So unless you grow the company, you will not be able to make your returns. The returns which at least PE firms strive for. So be it acquisitions, be it getting a great management team, and most important, getting revenue from our portfolio companies. These are the drivers which we bring to table. And it's not just taking out people or taking out cost. So that's my take on building businesses.
Yeah, I think from our perspective, the way we think about investing is a little nuanced. We think less as investors and we think as more as strategic partners to our companies. What that means is when we get into a business, and because we are backing a promoter, what he's looking at us is beyond capital, strategic advice of thinking through how do you build scale. What are the nuances of scale? What are the implications of scale? What can go wrong with scale? Because most of these guys have never really seen that size of business. A lot of the companies that we back, actually, I would say 99% of the majority of the companies that we've backed are coming from tier 2, tier 3, tier 4 towns. We've got a healthcare company, diagnostic company based out of Goa. So similarly, what happens is there is a lack of ability to attract talent in those geographies. There is inability to invest because they haven't seen what they need to do to build a business. There is sometimes a lack of understanding of how do you drive performance. Because reality of life is what you got you here will not get you ahead. And I think that applies to a lot of these businesses which kind of get stuck at a particular point. They may have grown great up to a point in time, but they are not able to expand beyond that. So as a fund, what we try to do is, there are at least 3 areas that we've identified, which are very core to us. The first is people. I think what you can't undermine is ability to institutionalize a platform, a business. While it will still be a promoter, it will be still his risk-taking capability, but creating that capability below him to create scale, I think that is very important. So that's one area where we partner with our founders to build capability. The second area that we try to partner is on the tech side. Now, I mentioned at the start we are a tech-focused fund, but we firmly believe that tech is a very large enabler. From as simple as being at a MIS level, data should be coming automatically, to the extent of robotic manufacturing. We're in fact helping one of our companies build some of those aspects. So tech has a differentiated play with respect to helping companies scale faster in a more sustainable basis. The third area that we typically focus on is performance improvement. So in our minds, we don't think of us as investors who come every quarter and ask why you did not perform. We try to work with them, with our team, because we've got a separate functional partner team, trying to help them. If there is a miss, how can we help you bridge that miss or bridge that gap? And how can we enhance your profitability even further? So those are strategies that we work with our portfolio companies extensively. Apart from this, one of the things that, while it is common across all PE funds, is on the governance side, but at least at a independent director level, we try to focus a lot more on relevant talent coming on the board. Because, like Ratna also rightly mentioned, people who have had experience in building businesses, when they come on board, there is a lot of receptiveness from the promoters to drive change, to accept change, to do what is required for growth. So I think these are some of the areas that at least we focus a lot on from a post-investment perspective.
Yeah, I'll try to be brief and cover a few areas that we see when we're evaluating opportunities and building relationships with entrepreneurs. I think first and foremost, find that venture investors are sometimes collecting call options on future business opportunities when they invest in a startup because they don't really know where the business trajectory is going to head. They just see a capable team, an interesting product, and a large TAM. I think by the time entrepreneurs need to raise growth capital, they have to start focusing. And that's one of the things that we really push our entrepreneurs to do when we back them. If it means not spending time or capital on certain lines of business, shutting down things that look promising but may not necessarily be core or value additive to what they're currently doing in the business, just starting to narrow down what are the key drivers of success for this investment and getting the entrepreneurs to focus on that. And sometimes when you're surrounded by other PE firms investing in a company, that can be done because everyone's aligned. And when you have different investors on the cap table, each believing that the company has different priorities and different ways to grow, you have to navigate that very carefully. The second thing is we're only going to do 8 to 10 deals in our fund. This is not some small investment we made that if we don't follow on, we can let it go. Which means if the business is not going as per plan, we really have to lean in. And this is similar to all private equity investors, but in the ecosystem we deal with, we may be one of a few, if not the only private equity investor on the cap table. So you see situations where the venture investors are like, well, we should just sell. It doesn't seem to be working out. And we come in and say, no, we think there's a way forward here, but the entrepreneur should be doing X, Y, and Z. And often that means you may not be the largest investor. You're spending a lot of time with the entrepreneur. You're really engaging with the team. Others have checked out, but you're really leaning in. Entrepreneurs really remember that. And you see some really interesting outcomes result from that as well. And then lastly, as sometimes we're the first PE investors to meet the entrepreneur, the level of diligence you do in advance, you're asking a set of questions the entrepreneur simply has not been asked before. And so that is actually a way you can build a relationship with the entrepreneur because entrepreneurs are like sponges. They just want great advice from people who are thoughtful and aligned. And so it's a great way to build a relationship. And we find that through that engagement, if the entrepreneur says, wow, this is really interesting insight, these guys can really help me build my business, then there's a fit. And if the entrepreneur is kind of like, wow, that's too much diligence, it's only a $10 million Series B round, why are these guys asking so many questions and why do they want to speak to our customers? That's when we know this is not a fit for us. So those are some of the ways we try to really engage and add value and be helpful, other than kind of, some of the other ways that were mentioned by some of our peers.
One point that I would like to add over here is that while all of us are like razor sharp focused on creating value, one of the things which at least we've seen in the recent times has become hugely important for value creation and for the investor to manage and build that out is the governance framework, right? We're seeing a lot of unicorns and the startup ecosystem buzzing. But we've seen examples also where companies were ready to go IPO and have not been able to do that because of issues with governance, right? So at a very early stage, most of us investors, and for us also it's the focus areas that we try to build in the governance frameworks such that as the company builds, because sometimes fast growth leads to a lot of loose ends being kept, to kind of tie those up and make sure that at every stage of the company, that check the box is done right.
Thank you. If anybody has questions, I think our panelists would be more than happy to answer them.
Hi, my name is Anubhav Agarwal. I'm a partner at Vata Gandhi, which is a Bombay hot-cottered law firm. My question is to Mukesh, and obviously if any other panelists, Vijay, Vineet, if you can add anything to this. You had mentioned, Mukesh, earlier that the landscape has, the private equity landscape has changed a lot now, and we have buyout deals happening, private equity investors like you, Blackstone, taking majority stakes and also taking the company to IPO stage, etc., etc. But if you see the entire private equity sort of landscape and the number of players in the market and how the entire market has shaped up, there are several other categories which have kind of sort of evolved, etc. But the number of buyout deals that are happening, right? So as compared to the other deals or other sort of private equity investors, the number of buyout deals or number of private equity investors which are taking majority stakes have not really gone up at the same scale. So is there something which is holding back the private equity investors to actually do lot many more majority deals and sort of take the do the buyout deals that way? Or is it just that there is a time lag that from an overall perspective is there, and this will happen probably in due course that you see?
So I don't know about the data where you have, but we track this almost on a yearly basis. From the time I started, as I made that point, 95% of the deals were minority deals.
Right.
Today, 80% of deals which are more than $150, $200 million are buyout deals. This number would have been 40% maybe 5 years back, or 30% 5 years back. So every year the number of buyout deals have increased. Having said that, it's easy and very fancy to say that our investment strategy is to do buyout deals. Buyouts deals, speaking on an Excel sheet, taking a 51% stake and operating a 51% stake in companies is very different. You need a different muscle power. We have also learned a lot from our mistakes. Every day there's a fire, be it a government issue, be it a manufacturing issue, be it a labor issue, and you need to develop that muscle power. That doesn't come overnight with you. Having done 25 buyout deals, that's how we have developed the muscle power. But specifically to your point, the number of buyout deals have increased a lot, and the only reason for that has been the maturity in terms of founders as well. They realize that the second generation, either they are not interested or they may not be capable enough to take their business to the next level, which a professional entrepreneur can do it. And that's a big change which we have seen. Especially from our point of view, we do only, in private equity, we do only buyout deals. And we're seeing some of our peers also going towards that strategy. And one more important function is not just what you build in the business, but it also helps you on determining your exit. You're not dependent on a minority shareholder who will take you public or who will make you an exit. That's a huge differentiation. If today you can do a dividend recap, you can do a secondary buyout, you can take your company public. So that's in your hands.
Hi, I represent an IPO communications agency, and we've worked with most of y'all in various deals. I just want an insight into the mind of the private equity professional in you as to, how important do you see public relations as a practice, from a value creation perspective on various of your deals? We have worked on many deals where we come very close to the DRHP filing, but why not get a PR agency on board to create that right perception way before the actual decision comes up?
I actually have an example over here of a company that I had taken IPO, say, about a decade back. And the IPO outcome was fantastic, right? We managed to get a good exit. Of course, it was not a full exit, as he had also said that Ps don't exit fully. But what happened after that was, it was an old economy company, old economy sector as well. And their investor relations post the IPO were a little laxed in terms of how they are managing it, because they were not used to it. Right? And therefore I realized that IPO, the quarter on quarter, the pressure which is there on the company, that needs to be really handled well. Whatever you're doing, your numbers might speak a story, but if you're able to explain that story well, whether internally or through, help from external agencies, I think that makes a huge difference. And when we saw, for a couple of quarters that was not going right, we intervened and we got somebody in to kind of help them with it. I think there was a huge impact. So I think IPO, success of the IPO at listing versus sustaining that and creating value, I think the management that is required in terms of communication, I think that is the key.
QSQT is of course going to be there for every company, post listing, but my question was more from a pre-IPO perspective, because as we all know, it takes close to a year's time, for a company to actually prep themselves up to, to go to market. If before, if an agency can come on board and help create the right perception, there wouldn't be as much of a rush that we generally have when the DRHP gets filed and we're all focused on issue-related PR communication. So,
I guess Ratna did touch upon this, right?
Yeah,
If you oversell the company, then you have a challenge post-IPO. I guess that's what you meant, right?
No, I think communication is the key. Just because business models are very different, and if it is not like a run-of-the-mill business model, it's very important to communicate whether it's at IPO or whether it is post-IPO in terms of, what the strategy is and how the numbers are panning out vis-a-vis that.
Any other questions?
Hello everyone, I'm Ronali. I represent Tanas Capital. It's a mid-market private investment firm. We, the panel discussed much upon IPO as an exit opportunity. These days, a lot of companies are also listing on the SME platform, SME IPO. So how do you see SME IPO as an exit opportunity for a mid-market private investment firm, mid-market private equity investment firm? And part two of the question is like, do you think that this SME listed companies can be a good investment opportunity also by de-risking the corporate governance part of it and then creating a value towards the main board listing?
Maybe I'll go on that one. So I think the SME listing guidelines, the kind of companies that come there, I think there's a 1 crore cap on the paid up capital of SME. So what's actually happening is that a lot of the companies which classically would have or should have raised private equity are going in a little early from a capital market perspective. Because the valuations there are very high, there's a little bit of an exuberance, demand is more than the supply, so valuations are kind of touching ridiculous proportions there. So from that perspective, it actually kind of is competing with private equity. But what that's also doing is probably getting a lot of companies much earlier than they should from a listing standpoint. Because ideally you should list at a stage where your business is a little more predictable. The cash flows, the profitability, etc. is a little more predictable. Listed companies also do take risk, but the risk can't be to the magnitude of a quarter's profit or 2 quarters of profit going away completely. So from that perspective, I think at a maturity level, a lot of these SME IPOs are tad early and very highly valued. There is an opportunity for PE folks to probably look at some of these plays. At least today, the kind of valuations at which SME IPOs are happening, I think that might not be the play today, but maybe in the future could be an opportunity.
So myself, Anand Pandey, I am representing iTech Robotics over here. My question is to Mukesh sir. So what exactly you mean when you speak about buyouts and controlled deals? So what sort of percentage, etc. What are the?
So just to be very clear, when we say buyouts, it doesn't mean that Mukesh Mehta is going and running the company. It is buying more than 51% stake. And having a say in the strategy, the key management appointments, and running the company through a professional board. So it's anything which is more than 51% stake is what we considered as buyout. And even if it is, 35-40%, but we are the largest shareholder and we have a say in the company in terms of who the key management team member would be, and we can run the company as a more professional corporate governance board versus just being a passive shareholder. That's what we consider as buyout.
Okay, my second question in line to that, how it impacts if a buyout deal is being offered by the promoters as far as valuation is being concerned?
So, in terms of founders, if a founder is looking at a 100% stake sale, the most obvious value to them is, irrespective of whatever we can say in terms of what we build value, for him, the most important value is what value you offer, because he's doing a secondary buyout. And the second criteria is, for a lot of founders, is not just the value. The company has to go in right hands. They've built the business over a decade, over 3-4 decades. They want to make sure that the company goes in the right hands, flourishes in the right hands. So that's a criteria for a 100% deal. But what we see and what we have created for a lot of our founders is the value of the balance stake. So I'll give you an example of a company called Taskus. We bought 60% stake in that company. We bought 30% stake from the founders, Bryce and Jasper, and 40% from the existing private equity investors. We bought this company for almost, I think, $500 million. It got listed at a value of $5 billion. Now, the balance 30% stake of the founders was worth much more than what it's sold as 30% stake, right? So I think what plays in the founder's mind is, if they are rolling over their stake, who's the right partner, who's the partner which can grow the balance business, and make sure that they align with that partner to make sure that the balance value is multiple of what they sell in the upfront. So that's how valuation is derived.
Hi, this is Pundrakaksh from AZBN Partners. I just had two questions. I'll try clubbing them together as much as I can. In our golden age of India's VC story, in the middle we had a little bit of a dip, especially when it came to governance norms, right? With companies not being entirely in rein. So I just wanted to ask, similar as how people were asking, the insider's tip to sort of sorting out the board mechanics when you're making an investment. And my second question is actually a little more perspective and into the future. At least for consumer-facing businesses in India, digital infrastructure and at least public infrastructure that the government built, most notably I think UPI, sort of really game-changed and kick-started a lot of business models. So is there something like that, some public digital infrastructure that you would be bullish on and you'd want that, that comes into play sooner than later?
I'll try answering the first one. Look, governance with respect to companies is something that I'm sure every single person on this panel is very focused on, right? And it's not specifically only related to the board. When you study the company and you go back in history, and a lot of us probably go back as far long as we can possibly can with respect to the track record of the company, there are multiple ways and checks that we do to ensure that this is a properly governed company. Combination of talking to all the stakeholders in the value chain, the people who deal with the company, their historical advisors. We obviously hire firms to help us with background checks and diligence on that aspect. And then finally also our personal interactions with not just the promoters and the management, but also with all the people in the value chain that we do. So, I mean, there are probably 100 such checkpoints that happen before any diligence that we do on a company before we get into it, right? And I think this also is partly science, partly art, that all of us have become better at over the last decade plus. And over time, the process of checking through governance and ESG and everything that goes with compliance has significantly improved, and that is why the number of such examples that you can find when you take the base of private equity or venture capital deals that have happened in the recent past have been much less than what it used to be 10, 15 years ago. But it's a continual process, and I think we'll have to keep working at it.
I mean, I'll just add a small point. I mean, what we've seen in the tech sector over the last 5 years and some of these governance blowouts, we've seen in the private equity industry for the last 20 years. So I think all of us have had some experience, and I completely agree with the point that you have to front load as much of this as you possibly can, because once you're in, it's an illiquid asset. It's kind of hard to get out. So you just triangulate as many ways as you possibly can through, ref checks, diligence, spending time with the entrepreneur, tracking them over a period of time, and then putting in whatever checks and balances you can. And one way we think about it is until you write the check, it's a diligence exercise until the very end. Even after you sign definitive documents, if the entrepreneurs, we've seen instances where the entrepreneur, after you signed definitive documents, did something, and then we pulled out and other investors invested. So you just can't, you can't compromise, and you have to front load as much of it as you can. On public infrastructure, it's very hard to really predict. I mean, we've seen what UPI has done. You've got ONDC, you've got BBPS, you've got Aadhaar, you've got Ayushman Bharat. I mean, there's account aggregator. There are so many things happening on the digital public infrastructure side. And of course, with Aadhaar and UPI, it's been nothing short of transformational for the tech sector. I think one of the things that we have to think about when we're investing in businesses is to what extent can a business model be disrupted by the emergence of competing digital public infrastructure. I mean, you may recall in the 2014, 15, 16 period, all these talk about wallets. But I mean, with UPI, wallets became redundant. And so, and even with UPI, pricing of other forms of digital payments processing have also come down quite a bit. So we have to also think about what are the implications of the success or the emergence of digital public infrastructure on closed loop business models. And what they'll become is distribution businesses that ride on the rails of that, but you do have to think about what the knock-on effects are, not only how your businesses might benefit from them, but how they can be impacted by them.
Yeah, I think that's really true. Like he gave the example of mobile wallets getting wiped out or changing their business models post UPI. I think what the health stack could do is there's a lot of AI around healthcare right now in terms of predictability and all. The building up the health stack for India, like how Aadhaar was built, could change a lot of that in terms of how prescriptions are written or how data is being leveraged by some of the pharma companies. Similarly, I think ONDC is going to be a platform where a lot of these e-commerce guys are going to be plugging in. Whether it's going to replace or not, not sure, because it's very early days for ONDC. But definitely a lot of business models will be built cognizant of that, saying that tomorrow if we have to leverage that platform, how do we kind of do that?
See, on the governance point, I just want to add one other thing to what Nitin just spoke about, right? We've all become smarter at it. And I think in our firm, there are a couple of principles that we apply, right? I think and maybe some of this learned the hard way. One is, we don't anymore believe in someone saying, I used to be like that, but now I've reformed. Okay? So that is a complete no-no. Even if the last 3-4 years everything is perfectly clean, but 5-6 years before there is something that you're not comfortable with, we still don't touch it. The other super important lesson that we've learned over time is there's never really one cockroach. If you find it, there are going to be others, right? So look, as an industry, we've learned over time, but I think we've become far better at it today than it was 10 years ago.
On a lighter note, just to add to what he's saying, I think earlier we used to do a forensic diligences at the fag end of the deal, right? Saying, oh, we have to kind of make sure that that is done. It's more of a check the box. But I literally changed that practice of saying that if I'm giving a term sheet, these days I'm doing the forensic diligences even before the term sheet, because that is one big determinant of in terms of how we want to kind of move ahead in the deal.
Hello. Thank you so much, panelists, for the valuable insights and the audience for the interactive session. I would request all of you to step forward for a group photo. I would like to call upon Nagarajan, Managing Director, Zenith HR, to give away the mementos and would request him to give it to Vijay first as he has a flight to catch. We now have our lunch and networking. We'll start our next session at 2:30.